Key points to remember from this chapter include: insurance is the transfer of risk from one party to another through a legal contract or the transfer of risk through the pooling, accumulation of funds. The benefit of insurance is that most contracts offered to individuals and organizations in society, including health, property, and casualty policies, are contracts of indemnity whose primary purpose is to pay off financial losses and reimburse the insured. Insurance evolved to produce a practical solution to economic uncertainties and losses. Companies that sell more than one line of insurance are known as multi-line insurers. Stockholders may or may not be policyholders. Life insurance creates an instant estate, regardless of when death occurs. There are two types of insurance companies: private versus government insurance. Companies that sell more than one line of insurance are known as multi-line insurers. A stock insurance company typically issues non-participating insurance policies. Non-participating policies do not allow policyholders to participate in board elections or dividends and instead aim to increase profit for the shareholders. Mutual companies are referred to as participating companies because the policy owners participate in dividends. Participating policies allow policyholders to participate in the company by electing the board of directors and receiving dividends from the divisible surplus. The divisible surplus is the amount of earnings paid to policy owners as dividends after the insurance company sets aside funds required to cover reserves, operating expenses, and general business purposes. A pure assessment mutual company operates on the basis of loss sharing by group members. A risk retention group or risk purchasing group only has to be licensed in one state but may insure members in any state. Reciprocal insurers are organized on the basis of ownership by their policyholders. To be characterized as a fraternal benefit society, the organization must be non-profit, have a lodge system that includes ritualistic work, and maintain a representative form of government with elected officers. Lloyd's of London is not an insurer, but rather a syndicate of individuals and companies that individually underwrite insurance. The company transferring the risk is called the ceding company. The company assuming the risk is the reinsurer. In a reinsurance agreement, the insurance company that transfers its loss exposure to another insurer is called the primary insurer. The most common reinsurance contract between two insurance companies is called treaty reinsurance, which involves an automatic sharing of the risks assumed. An insurer established and owned by a parent firm for the purpose of insuring the parent firm's loss exposure is known as a captive insurer. Surplus lines refer to the non-traditional insurance market. Industrial insurance is characterized by relatively small face amounts, with premiums paid weekly. A self-insurer establishes a self-funded plan to cover potential losses. The marketing or sales divisions are responsible for increasing the number of prospective applicants. The sales department is typically the department completing the application. The underwriting department is responsible for reviewing applications, conducting investigations to gain additional information about applicants, assigning risk classifications, and approving or declining an application. The claims department is responsible for processing, investigating, and paying claims for losses incurred by insureds. The actuarial department calculates policy rates, reserves, and dividends, and makes other applicable statistical studies and reports focusing on morbidity and mortality tables. In any dispute between the insured or beneficiary and the insurer, the agent who solicits an insurance application represents the insurer and not the insured or beneficiary. Agents are also classified as captive or career agents and independent agents. Career agencies are branches of major stock and mutual insurance companies that are contracted to represent an insurer in a specific area. 1868 Paul v. Virginia. This case, which the U.S. Supreme Court decided, involved one state's attempt to regulate an insurance company domiciled in another state. 1944 United States v. Southeastern Underwriters Association, SEUA. In the SEUA case, the Supreme Court ruled that the insurance industry is subject to a series of federal laws, many of which conflicted with existing state laws. As such, insurance is a form of interstate commerce to be regulated by the federal government. 1945, the McCarran-Ferguson Act. This law made it clear that the state's continued regulation of insurance was in the public's best interest. However, it also made possible the application of federal antitrust laws to the extent that the insurance business is not regulated by state law. 1958 intervention by the FTC. In 1958, the Supreme Court held that the McCarran-Ferguson Act disallowed such supervision by the FTC, a federal agency. Additional attempts have been made by the FTC to force further federal control, but none have been successful. 1959 intervention by the SEC. The Supreme Court ruled that federal securities laws applied to insurers that issued variable annuities and, thus, required these insurers to conform to both SEC and state regulation. The SEC regulates variable life insurance. 1970 Fair Credit Reporting Act requires fair and accurate reporting of information about consumers, including applications for insurance. Insurers must inform applicants about any investigations that are being made upon completion of the application. 1994 United States Code, USC, Sections 1033 and 1034. According to 18 USC, Section 1033 and 1034, it is a criminal offense for an individual who has been convicted of a felony involving dishonesty or breach of trust to willfully engage or participate, in any capacity, in the business of insurance without first obtaining a letter of written consent to engage in the business of insurance from the regulating insurance department of the individual's state of residence. 1999 Financial Services Modernization Act. In 1999, Congress passed the Financial Services Modernization Act, which repealed the Glass-Steagall Act. Under this new legislation, commercial banks, investment banks, retail brokerages, and insurance companies can now enter each other's lines of business. 2001 Uniting and Strengthening America by Providing Appropriate Tools Required to Intercept and Obstruct Terrorism Act. The Patriot Act, which amends the Bank Secrecy Act, BSA, was adopted in response to the September 11, 2001, terrorist attacks. The Patriot Act is intended to strengthen U.S. measures to prevent, detect, and deter terrorists and their funding. The act also aims to prosecute international money laundering and the financing of terrorism. These efforts include anti-money laundering, AML, tools that impact the banking, financial, and investment communities. 2003 Do Not Call Implementation Act. The Do Not Call Registry allows consumers to include their phone numbers on the list to which telemarketers cannot make solicitation calls. 2010 Patient Protection and Affordable Care Act, PACA. Often shortened to the Affordable Care Act, ACA, it represents one of the most significant regulatory overhauls and expansions of health insurance coverage in U.S. history. An agent is a person who acts for another person or entity known as the principal with regard to contractual arrangements with third parties. Express authority is the authority a principal deliberately gives to its agent. Implied authority is the unwritten authority that is not expressly granted, but which the agent is assumed to have in order to transact the business of the principal. Apparent authority is the appearance or assumption of authority based on the principal's actions, words, or deeds. Rating service in the insurance industry. A rating service company's primary purpose is to determine the financial strength of the industry's insurers. Reserves are the accounting measurement of an insurer's future obligations to its policyholders. Liquidity indicates a company's ability to make unpredictable payouts to policy owners. North Carolina Life and Health Pre-Licensing.